Hi there. This is Sally's Book Talk, bringing you the best books from around the world every day. Today we're discussing Lars Tvetees' Business Cycles: History, Theory, and Investment, Reality. This book serves as essential reference material for many economists and analysts in China. If you're wondering what Li Ka-shing's biggest secret to wealth accumulation is, or how John Paulson achieved 100x returns during the US subprime mortgage crisis, then you must listen to Business Cycles. This book will unravel the mystery. Economic cycles determine the prosperity of nations and cities, and can make or break personal fortunes. Why does Hong Kong seem less prosperous than before? Multiple factors exist, but cyclical forces dominate. What cycles? Economic reform and trade cycles. Mainland China. Initial limited foreign trade to few ports. Hong Kong handled majority of China's imports, exports during that period. As China's reforms created more economic zones and coastal hubs, Hong Kong's trade share shrank while over-relying on real estate. Failing to adapt to reform cycles marginalized Hong Kong economically. Li Ka-shing mastered Hong Kong's economic cycles, particularly its real estate and dollar cycles. Hong Kong's currency board system pegs HKD to USD. The HKMA must follow Fed rate hikes to prevent HKD depreciation. Similarly follows Fed rate cuts to prevent HKD appreciation, essentially mirroring US monetary policy. These credit policies significantly impact Hong Kong's property market, compounded by rigid land supply. Can you now discern Li Ka-shing's ultimate secret? Li Ka-shing became a billionaire by mastering these cycles, buying low and selling high through multiple real estate cycles. How did he do it? Whenever the Fed transitioned from loose to tight monetary policy, Li anticipated HK's credit tightening would lead to property market declines. He would then invest heavily in real estate during market lows. When Fed policy eventually shifted from tightening to easing, Hong Kong's property market would begin sustained growth. We would sell properties near peak values before easing cycles ended. As business sage Fan Li said, "Treasure cheap goods like jewels. Discard expensive ones like dirt." This philosophy of timing markets perfectly describes Li's strategy. Everyone wants to buy low and sell high. But how do you determine true market highs and lows? Understanding economic cycles reveals real valuations. Only then can we implement Fan Li's ancient wisdom effectively. Business Cycles blends professionalism with wit, making complex concepts accessible. The title's Eins capable suggests embracing rather than resisting cycles. Seize opportunities created by economic tides. Economic cycles are unstoppable forces. Ride them wisely. Cycles extend beyond finance. The Nile's flooding created Egypt's 7-year economic patterns. Tvetees considers these natural patterns as economic cycles. 7 years abundant, 7 lean. El Niño and La Niña similarly drive economic fluctuations. These climate phenomena alter ocean temperatures, affecting global weather and economies. The ENSO cycle impacts commodity, production, shipping, and consumption patterns. This explains commodity traders' fascination with climate economics. But Tvetees argues we should focus on 5 key economic cycles: credit, inventory, capacity, real estate, and asset price cycles. Technically, asset price cycles depend on the first 4 cycles. Understanding the first four cycles enables accurate asset price predictions. First, let's examine credit cycles, the foundation of modern economics. Why do economists emphasize the US dollar credit cycle? As the world's largest economy, US monetary policy, through the Fed, impacts global interest rates. Stock valuations, bond pricing, and commodity prices all correlate with interest rates. Even currency exchange rates depend on relative national interest rates. Global rates fundamentally follow Fed policy directions. Most currencies either peg to USD or manage float against it. How should China's central bank respond when Fed raises rates? To maintain currency stability, PBOC must mirror Fed rate hikes. What if China doesn't follow? Capital would flee to higher USD's yields, depreciating RMB. Can China avoid tightening while stabilizing currency? Capital controls become necessary, but with consequences. Heavy capital restrictions hinder RMB internationalization. Thus, China generally follows Fed's tightening pace with minor adjustments. This reality applies to most global economies. Li Ka-shing mastered Hong Kong's credit real estate cycle through this mechanism. Hence Wall Street's mantra, "Don't fight the Fed." This statement reveals a fundamental truth. Whether investing or speculating, credit cycles matter. The logic seems obvious, yet many still try to outsmart China's central bank policies. Post-1998 monetary reforms accelerated real estate commercialization and land monetization, deepening credit cycle impacts. Since then, ignoring central bank policy trends means missing major opportunities. After WTO entry in 2001 and before 2005 Forex reform, China's trade surplus required massive PBOC dollar purchases to stabilize RMB. Export earnings converted to RMB, deposits flooded domestic markets. Abundant deposits necessitated asset diversification. Surplus liquidity boosted demand for stocks and other assets. By mid-2005, stocks entered historic bull markets. Why did power tea prices skyrocket then? Credit cycle dynamics explain this phenomenon. Loose credit fueled speculation in tea and collectibles alike. In monetized economies, all assets dance to credit cycles' tune. No individual escapes credit cycles' influence. For professionals, credit cycles define career trajectories. Tadi's second cycle, inventory cycles, supply chain, stock fluctuations. He cites MIT Sloan School's beer distribution game experiment. 192 participants executives. Ombas played 48 sessions over 4 years, simulating beer, supply chain roles, brewer, distributor, wholesaler, retailer. Inval management seemed trivial for these professionals. Yet brewers accumulated massive inventories by week 20. By week 25, brewery backlogs reached 9x weekly consumption growth, demonstrating supply chain amplification effects. Brewery inventory fluctuations significantly outpaced retail-level changes. This microcosm reveals macroeconomic truth. Inventory volatility exceeds demand changes, creating economic instability. Hence, macro inventory cycles explaining recent destocking, deleveraging initiatives. 2016 commodity futures boom created legendary returns, with fortunes made from 20M to 1B. This directly involved inventory and capacity adjustments. Rebar's bull market combined capacity cuts, inventory cycles, and loose credit policies. Recent examples prove inventory cycle mastery essential for investing. This truth remains undeniable. In-bureau cycles last 3-4 years. The shortest academic economic cycle. When overlapping with ENSO and credit cycles, commodity markets surge. 2005. 2016 El Niño coincided with loose credit and declining sugar inventories. Stocks. These converged forces created sugar futures' historic rally. Now to capacity cycles, longer than inventory cycles. Juggler cycles, 17 years track equipment, investment patterns. Economists fiercely debate China's current cycle phase. Some claim new equipment investment, cycle signals, economic takeoff. Others cite debt, real estate risks. The intensity of debate reflects its critical importance. Capacity cycles crucially impact equity investors. When dot-com bubble burst in 2000, survivors like Masayoshi Son eventually thrived through cycles. How did these long-term holders ultimately succeed? They aligned with capacity cycles consciously or not. China's new 4 great inventions fascinate globally: high-speed rail, shared bikes, mobile payments, and e-commerce. Could these signal new capacity cycle opportunities? How to capitalize on such broad cycles? Answering requires deep cyclical analysis. Juggler cycles demand precise timing like expert butchers. Growth investors targeting 10-100x returns must respect capacity cycles. Forbes list fluctuations mirror industrial cycle phases. Coal tycoons vanished in decade, capacity cycles power exemplified. Historical tides lift compliant boats, sink resistors. Investors must interpret trends through capacity cycles. Today's 4th cycle. Real estate. China's perpetual hot topic. Homeowners celebrate price surges. Renters lament. National obsession since 1998 marketization. Economists compare to Japan's 1973. 1991 property bubbles. Commentators like Andy Z and Niu Dao attract media spotlight. If success measured by clicks, these pundits win. China's real estate remains nascent, formalized since 1998. Property sector intricately tied to credit via mortgages, securitization, real estate's upstream, materials, equipment, industries, and downstream decoration, appliance sectors are deeply impacted. A nation's economic cycles live through real estate. Prosperity and collapse often hinge on it. The subprime crisis originated from real estate, as did subsequent European debt crises, earning its cycle mother title. Studying economic cycles demands real estate analysis, the core gateway to comprehension. Homer Hoyt pioneered cycle studies through 100 years of land values in Chicago, analyzing every property record. His 1,831,933 research established authoritative cyclical patterns, through meticulous data analysis. Contemporary property discussions fixate on price fluctuations. Accidental predictions outnumber genuine insights in market chatter. 18-year real estate cycles feature prolonged appreciation phases. Persistent participation creates illusion of predictive accuracy. Hoyt's methodology emphasizes data-driven analysis over emotional speculation. Viral sensationalism differs fundamentally from professional research. John Paulson, fund manager, profited billions during the subprime crisis. Frequent name confusion occurs with former Treasury Secretary Henry Paulson. His $15 billion gains surpassed even Soros' historic trades, prompting mentorship requests. Paulson's success stemmed from mastering U.S. real estate macrocycles, mirroring Hoyt's approach. Rigorous data analysis, revealing cyclical opportunities. Let's explore his legendary trade structure. Some key moments were dramatized in The Big Short. How did Paulson engineer this historic trade? Previously unknown on Wall Street, Paulson remained obscure until his massive bet paid off. An undervalued analyst on Paulson's team made the crucial discovery about subprime loans. This underdog identified flaws in mortgage-backed securities, his breakthrough moment. How did subprime mortgages proliferate? Multiple factors beyond simple greed created this crisis. Origins trace back to Clinton-era housing policies. Democratic housing initiatives aimed at expanding homeownership. The solution: government-backed financial engineering. Wall Street seized risk, reward asymmetries, profits privatized, risks socialized. Financial alchemy transformed junk mortgages into AA-rated securities. Economists' irrationality explanations miss systemic incentives. This diagnosis proves superficial. Strict lending would have barred marginal buyers from homeownership, politically untenable. Borrowers acted rationally within flawed systems. Paulson's team recognized unsustainable leverage dynamics. Easy credit fueled construction booms and lax lending standards. Bernanke's rate hikes exposed payment to income mismatches. Diminishing returns met rising debt costs. Minsky moment precursors. Mortgage defaults became mathematical certainty. Paulson's team identified early warnings of impending crisis in U.S. housing and broader economy. Informed by economic cycle knowledge, Paulson recognized post-rate-hike credit tightening signaled late-cycle risks. U.S. real estate's prolonged expansion since Clinton-Greenspan era neared its peak phase. These intuitive judgments required rigorous data verification. They targeted Hoyt's methodology through exhaustive data analysis. Modern big data techniques couldn't replace their manual verification process. Data revealed rising defaults, despite market complacency, critical divergence. Securing CDs contracts required unprecedented Wall Street negotiations. Mortgage default swaps essentially bet against housing market stability. These instruments gained value as housing prices declined. Historical outcomes confirmed Paulson's 100x returns. The psychological toll manifested in daily stress relief rituals. Maintaining conviction required extraordinary discipline. Paulson capitalized on converging credit and property cycles. Two key factors enabled his success. First, mastering cyclical patterns as detailed in business cycles. Second, identifying precise financial instruments to implement strategy. Different asset classes respond uniquely to cyclical forces. Real estate cycles create both legends and casualties. Three cycle types exist: long, Hoyt's 80-year, medium, and short term. Short cycles correlate strongly with credit availability. To be clarifies, credit loosening, tightening drives short-term fluctuations. Real estate cycles aren't solely credit-driven. Migration, urbanization, land policies, and demographics all play roles. Construction timelines affect cycle phases, with real estate often leading economic recoveries. Hence, housing starts serve as crucial leading economic indicators for investors. U.S. housing start data significantly impacts forex markets. Pre-China's rise. It heavily influenced base metal futures markets. This demonstrates real estate's role as economic cycle progenitor. Now we've established four key cycles: credit, inventory, capacity, and real estate, interlocking to form economic rhythms. How can cycle knowledge benefit ordinary people? How to apply cycle theory to household finance. For investors, what's the cycle-asset price relationship? First, understand economic phases. Recovery, boom, stagflation, recession. Recovery, low inflation, high growth. Boom, high, both. Stagflation, high inflation, low growth. Recession, low, both. Capital allocation requires specialized cyclical knowledge. Sophisticated capital deployment equals strategic asset allocation. Teddy's cycle-based allocation strategy. Recovery phase, equities, commodities, real estate. Boom phase, real estate, commodities, art. Stagflation, commodities, especially crude oil. Recession, bonds and select equities. Remember, cycles overlap, particularly credit cycles permeating all others. You can observe credit's influence within inventory cycles. Credit's impact manifests clearly in capacity cycles. Naturally, credit's effect on real estate cycles becomes apparent. As discussed, Lee Cashing and Paulson's successes stemmed from credit real estate cycle convergence. Loose credit cycles lift all assets when the tide rises. All boats float. China's financial circles teem with credit cycle-focused analysts and economists. They excel at predicting asset trends through Fed and PBOC policy analysis. Simplistic in appearance, yet often outperforms traditional analyst forecasts. This circles back to the adage, "Don't fight the central bank." Few acknowledge this truth, often overlooking credit cycles for complex analyses. Recall how many real estate crash predictions we've witnessed over years. Yet, markets rebound higher after corrections. Does Chinese real estate defy cycles? Failed predictions typically disregard credit cycle dynamics. Persistent real estate bears overlook credit fundamentals while factoring other elements. Teddy repeatedly emphasizes real estate's role as cycle mother in economies. Scrutiny reveals real estate cycles remain credit cycle dependent. Thus, credit emerges as ultimate cycle driver. Wisdom lies in respecting its power. Soros, the alchemy of finance, systematizes his opaque market philosophy. Through Tedeschi's lens, Soros' success combines credit and property cycles. Soros claims his secrets reside within the alchemy of finance. Mastering credit real estate cycle interactions unlocks Soros' methodology. This secret permeates Tedeschi's work and business cycles, history, theory, and investment. Reality. Let's simplify further. Leverage, credit, real estate cycle, convergence. This constitutes the core strategy of Lee, Cashing, Soros, and Paulson. Internalize this principle through repetition. Embedded cycles also exhibit layered complexity. Traders favor 3-4 year inventory cycles for actionable timing. Soros, Livermore style, trend traders focus on inventory cycles for timely opportunities. Easy credit fuel inflation-driven inventory accumulation. This defines active restocking phases. Tight credit triggers deflationary inventory liquidation. Marking inventory to market becomes necessary during deleveraging. Clinton-era tech boom exemplifies credit-driven capacity expansion. China's post 2008 solar industry boom demonstrates credit capacity dynamics. Business cycles presence. Academic depth requiring economic literacy. Recapping core concepts. 4 key cycles. Credit in Vindro. Capacity. Real estate. Each cycle phases through recovery. Boom. Stagflation. Recession. Phases specific asset allocation. Optimizes returns. Credit to real estate cycle. Synergy determines investment success magnitude. Thus, we analyzed investment cases of Lee, Cashing, Soros, and Paulson. You'll notice they all capitalized on credit real estate cycle convergence for wealth creation. Ultimately, individual success. Failure hinges on cyclical positioning, the essence of Feng Kao industry trends. Economic cycles dictate trends Feng Kao, which govern wealth distribution patterns. Strategic cycle anticipation outperforms blind diligence in wealth accumulation. This concludes our analysis. Find key takeaways below the audio. Until next time.